My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. This is one of my favorite series that I have here on the channel. I do this about once a month. I really enjoy it because I love interacting with all of you. I love reading your emails and seeing, how different people view dividend investing all across the globe. So in today's Review My Pie, we're gonna take the exact same format. I wanna answer a question that I got here, an email that I got from someone, and then I want to take a look at three portfolios. The first question is going to be from a 53-year-old here in the US, and then the first portfolio is going to be from a 35-year-old in the US, the second a 52-year-old from Puerto Rico, and then the third a 60-year-old here in the US. So I'm really excited about this video. Most of the Review My Pie portfolios are somebody that's maybe in their 20s or 30s. It's great to see somebody in their 50s or 60s submit their portfolio, because time horizon plays a big role in how you invest, and I talk a lot about that. And so somebody that's maybe in their 20s is going to have very different priorities and going to have different goals than someone that's maybe in their 60s. And so I'm excited to talk about that. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links. And as always, everybody, please don't take what I'm saying as financial advice. It's just merely for your entertainment. And Puerto Rico, I think most people know where Puerto Rico is, right? If you don't know where Puerto Rico is, let's see here. So you got the US, you scroll down here next to the Dominican Republic, you got Puerto Rico. And I've never been to Puerto Rico, but I would really like to visit. One of my good friends is from Puerto Rico. And I've never met anyone from Puerto Rico who I didn't like or who was never nice. I think it seems like everyone from Puerto Rico is all named Juan. I don't know what it is, but I've never met a Juan that was not nice. And you never want to judge a book by its cover, because, you never know what you're going to expect when you run into a Juan, and it could look a little like this.
Only those who are worthy can pick up the hammer.
Super dangerous and not appropriate on the job. But since this is my company, it's okay. Oh, come on, you could have totally caught that. Now that was all hand.
How?
Okay, go deep. Dun, 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 dun.
Go deep?
Oh, I thought we were playing catch. I mean, we could play a little football.
Oh my gosh. Juan, son of Juan. Oh man, I can't contain myself today. All right, cool. So let's take a look at this question here from Homer. He writes, Jake, thanks for sharing. Oh my gosh, I gotta contain myself. Jake, thanks for sharing. First of all, I'm 53 and can be a retired teacher in Texas, which gives me a lot of leverage. I have other things like a Roth IRA, 403b, raw land, homestead that is paid for, but I want a monthly payout ASAP. What would you recommend? I saw your video about SHD and DGRO, and I'm intrigued by the simplicity. How much would you kick into those two, and do you add JEPI now? Thanks, and I look forward to your response, Homer. Well, Homer, it's great to see another Texan here. I guess really it comes down to what you're trying to do here. So the thing that I talk about with SHD and DGRO, I coined that is the simple path to wealth with dividend investing, inspired by J.L. Collins, who talks a lot about VTSAX or VTI when, looking at the 4% rule. The thing that I like about this is with SHD and DGRO, there's really too much. You can't invest too much into SHD and DGRO. Those ETFs, if you only held those, I think you're going to be completely fine if your plan is to live off the income of your portfolio. Really what it comes down to is your time horizon. When do you plan on living off of the income? And based off of what you're saying here, pay out ASAP. If you want the money today, DGRO and SHD, they're great, but they're a little bit different. So SHD is great if you have kind of a mid-term time horizon. DGRO is great if you have a longer term time horizon. I like them both together because they're better together. You're going to get more diversification, more market participation, and more growth, and also more income by combining them together. Now, if you want the payout ASAP, you're going to likely want to limit, DGRO, because that is focused more on growth and delaying the income due to the growth that you're going to see in future years in the back end. And if you want income today, you want to front load that with a higher starting yield, which is what you're going to get with SHD or JEPI. JEPI is a covered call ETF. I really like JEPI. I like JEPQ as well. Some of my largest holdings in my dividend portfolio. They're great to turbocharge your income, but I wouldn't go just all in on one or the other. I think, to be honest, how much would you how much would you invest into these two ETFs, and would you add JEPI now? It really comes down to your goals. And it's important to not forget the tax implication that's going to come with JEPI. If you're still working at 53 and you throw all your money into a covered call ETF, you have to understand how they're taxed. So you're going to have a pretty hefty tax bill if you're generating thousands and thousands of dollars now in a covered call ETF like JEPI as an example. So you're going to need to make sure that you have that in the back of your mind that come tax time, that's going to be a bigger issue than it may have been before, as an example. I think really at the core of what you're asking here is, can you invest, so much into SHD and DGRO, or maybe throw in another ETF and still, sleep at night? And I think the answer is yes. And that's why it's called the simple path to wealth with dividend investing. J.L. Collins was asked, if you got $1 million tomorrow or $10 million, I can't remember if it was 10 million or 100 million. And he was asked, well, what would you do with that money? He said he would throw it all into VTI or VTSCX, the total US stock market. And the person said, really? That's what you would do? And I take the same approach with dividend investing. If your goal is to generate income, and if I were to get, $100 million and I wanted to live off of my portfolio, the overwhelming majority I would throw into SHD and DGRO if that was my goal, to live off of the cash flow or the income from and not have to sell my shares. So it really comes down to what your goals are and what you're trying to do. DGRO, SHD, and JEPI, they're nothing more than vehicles, right? And your goal, your destination is when you plan on living off of your income. And so you want to make sure that the vehicle, the investment, matches your destination, which is an interesting way of saying, you need to understand how to invest based off of your investment time horizon. I would definitely recommend a combination of SHD, DGRO, and then a covered call ETF if you really want to turbocharge your income. And really educate yourself and understand how the indices work in these ETFs, and that'll help you sleep better at night and feel more confident in your decision, and not just blindly listening to a random guy on the internet, but you're really doing the research and educating yourself. So I hope that helps, and appreciate you sending over the question, Homer. All right, let's take a look at the first portfolio here. Here he writes, "Hi Jake, longtime follower of your YouTube channel. My question is, if you were to lump sum into a brand new account for only safe dividend paying stocks with no additional monthly deposits going forward except large lump sum deposits every 5 to 7 years, no dividend cash withdrawals, instead subscribing to DRIP for each, what do you think of this breakdown? Do you think I should have a slightly higher weighting into DGRO, JEPI, QQQ to capture more growth while keeping conservative with the other 22 holdings?" This is an interesting scenario. My investment horizon is likely 15 to 20 years, and I have income and speculative investments, thus using the DRIP and living overseas. So there's a 30% withholding tax from the US. This is considered a long-term nest egg. Don't want to actively monitor it. And I have other speculative portfolios, smaller but considerable. The stocks at the bottom are just some that I think I would want to switch into, but I cover the high-tech stocks with QQQ, etc., and S&P 500 with VOO, and other exposure from the 25 listed. So you got the breakdown here. I appreciate your time and opinion. I am new to the dividend journey. And P.S. I like the inserted funny clips in your videos, especially from the 90s. Best, Brandon. Hey, Brandon, well, thank you so much, man. I appreciate it. I think this is an interesting scenario. I think, at the core of what you're saying here, it comes down to a set it and forget it, right? Whether you're lump sum investing or dollar cost averaging, really the big thing is with, the differences between lump sum and dollar cost averaging is really, you're focusing on the forward dividend yield if you're lump sum investing, like what's the dividend yield today, And versus, dollar cost averaging, what has been the average yield of an investment as an example, if you're dollar cost averaging over an extended period of time. Well, the most important thing that I take away from your email here is what you're saying right here. This is considered the long-term nest egg, and you don't want to actively monitor it. If you don't want to actively monitor it, I think you really, really want to focus heavily on ETFs, especially if you're overseas and you're not actively looking and following up on your portfolio. It's probably best to probably have 70 or 80% into ETFs. That's kind of the core and satellite approach to investing that I talk about on my channel, where your core is SHD and DGRO. For example, if you want to never sell your shares, you could have other satellite positions like a QQQ, where you're getting growth, where you're going to buy it today, hold it, sell it, and rebalance it later. With JEPI, I would eliminate JEPI entirely. You would look to add JEPI or another cover call ETF much later, once you reach your time horizon in 15 or 20 years. For now, you want to completely disregard this. It's attractive with a high dividend, but it doesn't fit your time horizon. Even in a tax advantage account like a Roth IRA, completely ignore it. You're going to sacrifice total returns for the dividend today. It's just absolutely not worth it. Okay. Whether you're, you or anyone watching this video, you definitely want to avoid that. So I guess, when looking at this, the key thing here is you don't want to actively follow up on it. So you want to make sure that these companies are not, going to disappear overnight and that they're going to be here in 15 or 20 years. And so, some of the companies you got McDonald's, Altria Group, Coca-Cola, Procter & Gamble, Exxon, Chevron, JP Morgan. Well, Brendan, I like your strategy. I like the companies in here. I like the ETFs, with the exception here of JEPI. That's not something that you want to invest in today. If you're looking at this to lump sum, I think, keeping it as simple and straightforward as you possibly can. With the 30% tax withholding, are you sure about that? Are you sure about that? When I was living overseas, you don't pay international tax on U.S. stocks while you're living internationally. You have the foreign income exception or something like that. I would definitely read up on that. That seems off to me. When I was living in Germany, I didn't have to pay 30% withholding tax while living outside of the U.S. So that's something you might want to check on. If you're only lump sum investing every couple of years, making sure that this is simple, very passive, having 80% into ETFs, I think is the way to go. And then have the other 20% allocated across your individual stocks would be my approach. And I really like QQQ. It's focused on growth. I like SHD and DGRO as a core, especially if you want to pursue a dividend growth strategy and live off of the income from your portfolio. But yeah, all in all, I like it. And I hope that that's helpful to you. I hope that reassures you that you're on the right track. But yeah, keep in mind, automate it, keep it as simple as you can. And you do that by really focusing on ETFs, especially if you're not going to view this. If you were looking at your portfolio every couple of weeks, I would say, hey man, keep it, you could keep it the way it is. You could have maybe 60 or 70% into ETFs. But because you're not going to be viewing this on a regular basis, keeping up on them, I would definitely skew heavier in ETFs. But yeah, Brendan, thank you so much for sending over your portfolio. I hope that this was helpful. All right, the next portfolio is Juan, son of... Oh my gosh. All right, I got to contain myself. Jake, loving the content every week. My name is Juan, and I am 52 years old from Puerto Rico. I'm currently retired from my first career as a soldier in the U.S. Army and still work for my company in the civilian sector. That's awesome, man. Congratulations. I'm fortunate enough to have a military pension, and perhaps this was the major condition for me to have very little saved for retirement. I am now putting away $4,500 per month for my retirement, which I expect to have fully funded by in the next 5 years. I love your opinion on my portfolio as it is now, and for the future living off of my pension and the dividends from the portfolio. Okay, please comment it. I hope to see my pie review and look forward to your comments. You're working here with a pension. You're investing a ton of money every single month. This is absolutely incredible. So you're going to have a lot of options by investing so much, having a pension. Because you have the pension, it offers so much flexibility to delay to focus more on quality, delay the income in your dividend portfolio because you're getting that pension. All right, let's take a look at your portfolio. Looks like you have 69 holdings, you have a really high dividend yield, and you have an expense ratio of 0.24%. So you mentioned that your time horizon is within about the next 5 years. So 5 years is not a long time away. 5 years is right around the corner. And so you could get away with having a higher starting yield. 5% is definitely on the higher end, but what I would definitely not do is focus maybe on, a 1.5%, 2% dividend yield. I think that is too low for your time horizon. And let's see how you have it set up here. So first off, I'm not a big fan of having so many different companies in here. And I can be honest with you, Juan, I started out in a very similar way, and I learned that this was just too complicated, right? Like, you're probably going to find out that it's just not very optimal to have so many different companies. When you go through and you do a stock screener and you look at all the great different companies there are out there, it's kind of difficult to pinpoint on where you want to focus your energy because there's so many great companies. There's so many great Pokemon, you got to catch them all. And, but that's not always the best way to go about this. So let's take a look at this. Let's see, you got everything equally weighted at 1%. Well, that definitely is going to spread out your risk. Do you know all of these companies? I mean, there's a ton of them that I know. Some of them I don't really know. Is this a REIT, Spire? Don't really know them. Sonico, I know them. Pretty good paper company. Good, utility company. REIT, Procter & Gamble, Pepsi, Arbor, Oreo. You have some really good companies in here. Next year, Energy, 3M, RIP. I think they just cut their dividend. I think they spun off some of their business, kind of like T-Mobile did. So they're going to be cutting their dividend. Medtronic's good. Okay. Kimberly-Clark, Kraft, Johnson & Johnson. So you got some really good companies in here. I guess really the question is, do you really want to follow up on all of this? Like, did you know that 3M is going to be cutting their dividend? Did you know that Walgreens just cut their dividend? Like, are you keeping track? Did you know, I think it was 2018-19, that Kraft Heinz cut their dividend, right? Are you following up on these companies? And if the answer is, well, yes, but not really. And if you don't really enjoy following up on these companies and keeping track of what's going on, this is probably not the approach for you. If you're a total nerd and you love staring at this and seeing, being invested in all these different companies because you absolutely love it, go for it. Be my guest. I think that's awesome. What you will quickly find as priorities in your life change, and I'm speaking from firsthand experience here, as priorities in your life change, your time changes in where you want to focus your time and energy. And what I found was that this was not something that I wanted to do long term. Now, I want to paint a really scary, dark picture here for a second. Now, in your email, you didn't say if you're married. You didn't say if you have kids, if you have heirs or beneficiaries for this account. What happens if you're, say, for example, you're married? What happens if you were to pass away or something dramatic were to happen? Would your wife or significant other be able to take over this portfolio? Would they be able to manage this the way that you are able to do it? And I want you to think about that for just a second. And the answer is probably not. And that's why, another reason why I'm not the biggest fan of going so wide and spreading out into all these different companies, because it makes it really difficult when you get older and when you have to kind of declutter your life. As have you ever heard about older people downshifting, moving out of their big home into a smaller home? That's something that you may want to slowly start thinking about, because that's what I think about when I see something like this. Okay. So all the individual companies, I don't think, I could poke holes at at some of them and say, oh, okay, well, there's only 1% weighted in here, so it's not going to really move the needle on the individual companies. But let's see what you got in here. You got PIMCO Income Opportunity Fund. Okay. You got VYM, SHD, and you got the Liberty All-Star Equity Fund. Okay, so it's definitely skewed heavier into a higher dividend yield. I've not really looked into these ETFs in detail. This one here, I'm assuming is it a covered call ETF? It has a really, really high expense ratio. I'm not the biggest fan of this one. If you really want an income ETF, I like, as an example, I really like JEPQ or JEPI, something that you could definitely consider. USA, what do you got in here? Expense ratio is just really, really high. High dividend yield. Yeah. So I would definitely recommend, in comparing PTY and USA, I would take a look at JEPQ or JEPI as covered call ETFs as an example, something to consider. I like VYM, I like SEHD, and something that you could maybe consider adding at maybe 10% is a DGRO, because you're still going to want the portfolio to grow. And if you add something like a DGRO, a lot of these other growth companies in here, there's a few growth ones, right? With Texas Instruments as an example. You can replace the growth that you would miss if, for example, you were to take the individual company out. You can add a little extra layer of growth with DGRO. Or, you could add, individual company, right? Like you could do that. That's fine. It's really up to you. I have just found personally that it makes it easier if you have it spread across ETFs, right? Like a DGRO or SEHD. But if you wanted to have an individual company, there's a lot of great ones out there. You could have, Microsoft as an example is a great growth individual stock, or an Apple, or, a Lowe's or a Home Depot, right? So just a few examples, something to consider. All in all, I'm not the biggest fan of this. You're going to quickly find that you're going to end up changing your mind a lot with a strategy like this. And so for that, I probably would recommend you reconsider the strategy here. Think about how you can simplify this and make this simpler. It seems maybe counterintuitive. Don't think that simpler is inferior, okay? Simpler does not mean inferior when it comes to investing. In fact, quite the contrary, I think simpler is better, okay? So yeah, Juan, thank you so much for sending over your portfolio. I hope that was helpful. All right, the last portfolio is from Randy. He writes, "Hi Jake, really enjoy your pie series there. Could you analyze my pies? I'm 60 years old next month and currently have the following assets. I'm hoping to retire at around 65 or sooner if the layoff bugs gets me. I'm currently trying to replenish my accounts after a brutal divorce 5 years ago. You have a primary home of $800K, you have equity, so $800K equity, but still owe $300K on a 2.5% mortgage, just making the minimum payments." Absolutely, man. I'm no Dave Ramsey. I would 100% keep this as long as you possibly can. That is free money right there. That is incredible. You won the lottery when it came to your mortgage there. So you got a combined 401k and IRA accounts. You got 464k, 34% into SHD, 6% into DGRO, and 60% money markets earning 5%. Okay, interesting. I get asked all the time, and there's always so many nasty comments on my videos like, why would you invest in a dividend stocks when you could just get 5% in a money market? It's like, well, yeah, I mean, that's cool. First of all, I feel attacked and you need to calm down. There's so many comments when it comes to that on videos lately. Like, oh, you're so stupid. Just invest everything into a money market. Because that always worked in every single time in history. I'm just like, what? Okay, I'm letting my frustration out. I'm venting. I don't have anybody else to vent to, so I'm going to vent into the microphone here. Yes, you can get the 5% in a money market. It can make sense, absolutely, if you need the money in the short term. But what happens when rates go down potentially, right? No one knows. But yeah, money markets can be great. They're amazing right now in today's environment. So taking advantage of that is incredible. So kudos to you. It's risk-free. So why not take advantage of it? Does it make sense that for example, should a 20-year-old put all of their money in a money market? Probably not, because they're probably not going to be able to time the market when the market flips if interest rates were to go down, as an example. So, but yeah, for you, Randy, at 60 years old, having so much in a money market, I think this is a little bit high. I probably would, we'll touch on that in a second. Okay, I have some thoughts on that. The next one here, you got your taxable account. You got 150K, 10% into SHD, 5% in DGRO, and 85% in a high yield savings account at 5%. And you have some emerging funds as well. So you have a lot in cash. Okay. So your current salary is you're an engineer. That's great. I was planning on eventually moving much more of the high yield savings account and money markets into my core SCHD and DGRO, with maybe 30% into satellites like VOO, VGT, SMH, cool, SOXQ, MGK. Haven't quite decided which ones yet. Okay. However, it's hard to give up a guaranteed 5% yield right now, especially with today's AI melt up, overvalued stock market, uncertainty with recession and market crash, 34 trillion in government debt. I mean, you probably have a bunker and have a lot of peaches canned in your basement. So I wish that I could do that, but no, you're right. The world sucks right now. So any advice on when to start moving into some of those other ETFs, which ETFs to pick, which ETFs are at fair value? Ooh, that's a good question. Okay, so there's a lot to unpack here. One thing that I would not do, and I think history has proven this time and time again, is don't, especially if you're younger, if you're 60 years old, you obviously want to skew more conservatively. If there's somebody that's 20 years old, I wouldn't be thinking about a looming recession or market crash. In fact, I would welcome it if I was in my younger years and still investing and still dollar cost averaging. However, if you're, approaching retirement in the coming years, you want to invest a little bit more conservatively. You're 60 years old and you're still working in tech. And I thought that was funny with the layoff bug. So you're waiting until they come get you and lay you off like all the other engineers. So I think you're asking the right question, down here is, why would you want to move into something else when you're already getting 5%? For you, it can make a lot of sense to have the money in a high yield savings account, getting a guaranteed 5%. If you already have your money, it depends on what stage of life you're in. Are you in wealth accumulation or in wealth preservation? For all of those of you watching who are in wealth preservation, the 5% high yield savings account is the best thing since sliced bread. If you're in wealth accumulation mode where you're younger, a high yield savings account is not the way to go. Okay. And so that's why, when you read comments and you see other people's opinion, context matters and your particular situation matters so much. For you, someone who's retiring fairly soon, I think having more in cash is probably not a bad idea, but I definitely would not have all of my money in a high yield savings account. Okay. Because essentially you just don't know what the market's going to do. You don't know when the next crisis is going to happen. And in fact, I would argue if we have another crash or another crisis, what do you think the Fed's going to do? They're going to lower interest rates. They're not going to raise interest rates in a crisis. Okay. And what happens when interest rates go down? Asset prices go up. The stock market goes up. Okay. It's kind of counterintuitive. You don't think about it that way, but in a crisis, right now we're in an artificial Fed designed crisis. The Fed is trying to slow. If we have a real crisis, the Fed will try to stimulate and boost the economy by lowering interest rates and thereby boosting asset prices. And then what's going to happen to those 5% high yield savings accounts? Well, they're going to get wiped out. They're going to go down. And so that's why you want to spread your wealth across, you want to diversify your wealth across different strategies and accounts so that you're prepared regardless of what happens. So what I would say is don't think so much about what the Fed is doing, what the market's doing. Focus on what you can control. And what you can control is diversification. You can diversify your wealth and where you have your money. Right now you have a home. Okay, so you have a home, you have that. That's diversifying your net worth, your wealth. That's great. You have time diversification because you have a mortgage. Right? You have time diversification right there. Okay. And so I like that you're focusing on SEHD and DGRO. You're 60 years old. You could live another 30 years. So you want to make sure that your income is still growing. SEHD and DGRO are going to grow about 8 to 10% year over year. What percent is this 5% going to grow year over year? That's the question that I want you to ask yourself. Yes, you're getting a 5% today. What is that 5% going to do in 5 years? In 10 years, in 20 years? Are you still going to be getting 5% in 20 years? Where SHD and DGRO will have gone up 8 to 10% on average, looking back, right? I don't have a crystal ball, but you could assume, right, conservatively around an 8% combined. So you don't want to be having blinders on and just looking right in front of you, but you want to have the big picture. Well, how is that 5% going to be growing? Is it going to keep up with inflation, or is your purchasing power going to go down over time? And so that's something that you absolutely want to keep on your mind when you're looking at this and how you're investing. And so what I would suggest is come up with a percentage that you're comfortable with, that you're diversifying. But I would diversify out of these high yield savings accounts and put them into, assets where they're going to grow over time, because you could live another 30 plus years. And, the question here, what ETFs are at a fair value? And to answer your question when it comes to, how to know if an ETF or an investment is a good value or a good time to buy, what you can do is you can kind of look at historically how the ETF has traded. And so one way that I like to do that, I like to go over to Seeking Alpha. This part is free. You don't need Seeking Alpha Premium for this. So everyone can do this. What you do is you go over to SHD, go under the dividends section, and then go under dividend yield. And what you can do is you can check and see over the last 10 years, what has been the starting dividend yield? And is today a good time to buy? Now, I do this all the time, especially if you are lump sum investing. This is something that I generally will look at. So something that I like to do is, looking and seeing over time, how is it traded and what has been the forward dividend yield, in the past. And so today, if you were to invest today into SHD, you would get a forward dividend yield of about 3.5%. Now, if you were to compare that with 2022, your forward dividend yield, or the end of 2021 as an example, you would have gotten lower than a 3% dividend yield. Okay, and at the peak of the pandemic and the fear in March, you would have gotten a 4% forward dividend yield. And so you can kind of look at this and see, okay, is now a good time to buy? And you can do the exact same thing with DGRO. So to answer your question with SEHD, it's not the worst time and it's not the best time. I think it's a reasonable time to invest into SEHD. When looking at DGRO, when looking at the forward dividend yield, it's averaged right around, just under 2.5%. And it's right around that average. Now, if you're getting less than a 2% forward dividend yield, I would say, no, that's not a good time to buy DGRO. But anything right around 2.5%, in my opinion, is absolutely fine. Okay. And that's how I look if now is a good time to buy. Another one that you can, just as an example, let me take a look at PepsiCo, just as an example. With PepsiCo, you can see here that it's averaged right around just under 3%. So it's right around its historical average. You'll see here back in 2023, right now would have been a horrible time to buy Pepsi, right? And so, you have something that's called the reversion to the mean, and what goes up comes down, and, prices get overvalued, undervalued. And this is a quick, easy way to see, okay, based off of historical trends, is now a good time compared to historical trends, but you don't have a crystal ball. You don't know what's coming around the corner. That's why this is much more powerful with ETFs, because this does not prevent you from what is called a yield trap. A yield trap, I'll give you one example. Let's look at 3M. Or 3M, let's look at Walgreens. Walgreens is maybe a better example. With Walgreens, with individual stocks, this can be a little bit scary because let's say in 2023, a year ago from today, you would have looked at this and said, hey, Walgreens is at 5.5%. Oh, the average is right around 3%. Oh, this is a great time to buy. Well, oopsies. In fact, it actually got worse and worse and worse. And the fact that they're now cutting their dividend. This was a classic yield trap. And with dividend ETFs, you don't have yield traps like you have with individual stocks. The highs are higher with individual stocks, but the lows are lower. And that is why I love investing into ETFs, because it's simple. It's simple, guys. It's the simple, I call it the simple path to wealth with dividend investing for a reason. Okay. And that's why I love ETFs so much, because you don't know what's around the corner and you don't have to know. So Randy, I hope that helps with the fair value question. I can't really help you with this other than, with the government overspending and all that, stuff going on. Just focus on what you can control. These other ETFs, the other satellite positions, I like that you're focused on ETFs. I like VGT. I like VOO. These are really great ETFs. It's just really understanding what the purpose is. What are you going to do with these ETFs? Is the goal in 10 years to sell them and to buy a new car? Go on an expensive vacation? What's your goal? But I do like having satellite positions as growth ETFs. I really, really, really like that. So that's great. When it comes to your allocation, I think you know it, like having so much in money market and high yield savings accounts, they're great today, but you're only thinking about today. You have the next 30 years to think about. Okay. And so that's why I would slowly think about how you can diversify away from having so much in cash. Okay. And so that's just my opinion, something to consider. I like SHD. I like DGRO. You could even, what you could do is you could consider here in the next couple of years to start, looking at covered call ETFs like JEPQ or JEPI. Those are great options for someone in your time horizon to get a little bit more of a higher yield, but that yield has the potential to continue growing. So that's my take on that. Thank you so much for sending over your portfolio. Everybody, thank you so much. If you're still watching the video, I hope that the video was helpful for you. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.